Navigating a global economic crisis can feel like sailing through a storm without a compass. Markets tumble, fear spreads, and every headline screams, "Sell everything." But what if you could see opportunity where others see chaos? In the next 30 seconds, you'll discover why crises often mark the best times to invest and how a calm, strategic approach can turn uncertainty into lasting wealth. Ready to learn the secrets of crisis-proof investing? Let's dive in. Welcome to Finance School. Today's topic, how to invest wisely during a global economic crisis. Let's go to our video. When economies shrink and markets wobble, most investors panic. They sell their positions, lock in losses, and flee to cash. But history teaches us that global crises, whether financial, geopolitical, or health-related, often sow the seeds of the next bull market. The key lies in preparation, perspective, and patience. In this comprehensive guide, we'll cover 1. Understanding economic crises. 2. Mental and emotional preparedness. 3. Building a crisis-resilient portfolio. 4. Identifying safe havens versus high-growth opportunities. 5. Timing your entry and exit. 6. Case studies, crises that created fortunes. 7. Practical steps and tools for crisis investing. 8. Long-term mindset and ongoing risk management. Let's embark on this journey together. By the end, you'll know exactly how and where to allocate your capital when uncertainty reigns. 1. Understanding economic crises. 1.1. What triggers a global crisis? Global economic crises can originate from various sources. Financial imbalances, e.g., excessive leverage, asset bubbles, geopolitical conflicts, trade wars, sanctions, pandemics disrupting supply chains and consumption, natural disasters causing resource shortages, policy missteps by central banks or governments. Despite different triggers, all crises share common phases. 1. Euphoria and overconfidence. Asset prices surge beyond fundamentals. 2. Shock and panic. An unexpected event shatters confidence. 3. Despair and capitulation. Investors sell at rock-bottom prices. 4. Recovery and rebirth. Stabilization leads to renewed growth. Recognizing which phase you're in can guide your actions, buying when others panic and trimming exposure as euphoria returns. 1.2 Historical patterns. 1929, crash in 1930s recovery. Stocks lost 90%, bottomed in 1932, then rallied into WOT. 1973, oil crisis. Energy shock triggered stagflation, but value stocks outperformed. 2008, financial crisis. Banks collapsed, but tech giants launched decade-long rallies. 2020, COVID-19 crash. Markets plunged 34% in weeks, then soared to new highs within a year. These examples show two truths. 1. Crises are painful but temporary. 2. Patient investors who allocate selectively at the lows reap outsized rewards. 2. Mental and emotional preparedness. 2.1 Overcoming fear and herd instinct. Humans are wired to follow the crowd, especially under stress. Yet, buying low requires going against the herd. Techniques to build emotional resilience. Predefine rules. Establish allocation rules before a crisis, e.g., a target of 20% in defensive assets, 10% in opportunistic value stocks. Use checklists. A crisis investing checklist, market valuation, liquidity needs, risk limits, prevents rash decisions. Mindfulness practices. Daily meditation or journaling reduces panic-driven trades. 2.2 The power of a written plan. Putting your crisis investment strategy on paper, complete with objectives, permissible asset classes, and exit criteria, shifts decisions from emotions to logic. Review it monthly, adjust for changes, but only during stable periods, not in the heat of market turmoil. 3. Building a crisis-resilient portfolio. 3.1 Diversification, your first line of defense. Don't put all your eggs in one basket holds true in crises. A well-diversified portfolio weathers shocks better. Equities. Blend growth, tech, healthcare with value. Utilities, consumer staples. Bonds, high-quality government bonds often surge as investors flee risk. Commodities, gold, silver, and selected industrial metals serve as inflation hedges. Real assets, real estate and infrastructure yield steady cash flows. Alternative strategies, managed futures, long-short equity funds that can profit in down markets. Rebalancing quarterly locks in gains from uptrending assets and redeploys into oversold ones. 3.2 cash reserves. The dry powder holding 5 to 10% in cash or cash equivalents during normal times ensures you can buy assets at distressed prices without forced selling. The yield may be low, but liquidity is priceless in a crisis. 4. Identifying safe havens versus high-growth opportunities. 4.1 Safe havens. U.S. Treasuries, historically negative correlation with equities during downturns. Gold, crisis psychology, and currency debasement drive gold prices higher. Defensive stocks, utilities, consumer staples, healthcare maintain revenues even in recessions. Action: allocate a core defensive sleeve, 20-30% of your portfolio, to safe havens. 4.2 Opportunistic sectors. Crises reshape economies. Opportunities emerge in technology disruptors, companies enabling remote work, digital payments, automation, healthcare and biotech, R&D for treatments, telemedicine platforms, renewables and ESG, green energy and sustainable infrastructure often outlast cyclical swings. Undervalued financials, banks trading at steep discounts may rebound post-crisis. Tip: use value screens, low PE, strong balance sheets to pick survivors with growth potential. 5. Timing your entry and exit. $5.1 cost averaging DCA. Rather than trying to time the exact bottom, invest a fixed amount monthly. DCA reduces market timing risk and smooths out purchase prices. 5.2 Opportunistic lump sums. If markets plunge 20-30% quickly, consider deploying a predetermined crisis tranche. For example, invest 10% of your portfolio when the S&P 500 is 25% below its 52-week high, another 10% at 35%, and so on. 5.3 Exit signals. Valuation metrics, PE ratio returning to historical averages, sentiment indicators, extreme optimism in surveys signals potential tops, monetary policy shifts, Fed rate cut cycles reversing can boost risk assets. Have clear profit-taking rules, e.g., sell half of your crisis fund allocation when markets recover 50% from the bottom. 6 Case studies, crises that created fortunes. 6.1 Warren Buffett and the 1974-1982 bear market. Buffett wrote, "Be fearful when others are greedy, greedy when others are fearful." He deployed cash to acquire undervalued businesses, generating decades of compounding. 6.2 Microsoft and the dot-com blast. While tech stocks crashed 80% between 2000 and 2002, Microsoft, Amazon, and Cisco held up relatively well due to strong cash flows, rewarding long-term holders enormously. 6.3 Moderna and the COVID-19 surge. Moderna's stock was relatively unknown in 2019. By mid-2020, after clinical trials news, it soared over 500%, illustrating how crises accelerate innovation winners. 7 Practical steps and tools for crisis investing. 7.1 Screening tools. Value screens, low price book, low debt equity ratios. Momentum filters, identify sectors reversing downward trends. Quality metrics, high return on equity, consistent free cash flow. 7.2 Automated alerts. Set up price alerts for key indices, S&P 500, NASDAQ, bond yields, gold, and Forex. Apps like Seeking Alpha or TradingView can notify you of threshold breaches. 7.3 Financial advisor or robo-advisor. In complex crises, a human advisor brings perspective. For simpler strategies, robo-advisors ensure discipline. 8 Long-term mindset and ongoing risk management. 8.1 Review and adapt quarterly. Reevaluate allocations every quarter. Crises evolve, new threats emerge, old ones fade. 8.2 Continuous learning. Read reputable sources. Central bank reports, Fed ECB minutes, economic indicators, unemployment, PMI, CPI, corporate earnings calls. 8.3 Community and accountability. Join investing communities or mastermind groups. Accountability partners keep you honest and share insights, essential during turbulent times. Conclusion. Investing during a global economic crisis may feel daunting, but armed with knowledge, a written plan, and emotional discipline, you can transform chaos into opportunity, build a diversified, crisis-resilient portfolio, identify safe havens, and unearth growth champions. Use DCA and opportunistic lump sums, and keep a long-term, learning-focused mindset. History favors the prepared. By acting wisely now, you position yourself for outsized gains once the storm passes. Remember, crises are inevitable, but calamity is optional. Your strategic choices today lay the foundation for tomorrow's prosperity. So, what will you do when the next crisis hits? If you liked the video, don't forget to like and subscribe to our channel. See you in the next video. Goodbye.